and they go, hey guys, guess what? Not really worth the dollar that we were saying it was per share. Sorry about your luck. And a lot of people went, wait a second, I lost money in my money market. How do you lose money in a money market? Because it was a money market fund, not a money market bank account. Big difference there. So there's been a lot of turmoil in the financial markets, and now it's leaching into the economy over the last year and a half or so. One of the nice positives that's come out of it for the consumer is if you've got cash, you can actually make a little bit of money from your cash now. For years, that wasn't the case. We had 0% interest rates. Money in the bank was earning almost nothing, and now that's starting to change. And I read an article lately about all the money flowing into money market funds, and it brought me back to something that happened in 2008, and I want to talk about it today because you might not be aware of it. There's a key differentiator here. A money market fund is different than a money market account at a bank. If you go into your bank and you say, oh, what's your rate on your money market account? That's a kind of a combination between a savings and a checking account, but it's ultimately an account that's subject to FDIC insurance. It's a bank account. Money market funds, that's typically a mutual fund. If it ends in X, it has a ticker, that's a mutual fund, and that's very different than an FDIC insured money market account at the bank. You hear money market, and a lot of people think they're the same thing, and they are not. So I'm going to outline what a money market fund is and how it's different, and then some of the risks and what you need to consider when you're looking for a place to park your cash right now. So here's the thing. There are different versions of these money market funds. None of them are FDIC insured. None of them are bank accounts. That's the first thing. Get that right out of the way. This is very different than, even though it's called a money market account, very different than what you get at the bank. You've now crossed the threshold into the land of investing. They get to make it look similar because they have a steady, what's called a net asset value or a NAV at $1. So they say, oh, the price is $1. So if you have $200,000 in a money market fund, it looks like $200,000 in a bank account, but it is not a bank account. So that value does not have to fluctuate. They have a special carve out where they say, oh, we don't have to mark it every single day to what it would actually be worth because it's invested in short-term things and that sort of thing. And so they get to live in a special place, even though it's actually an investment. Where that comes into play is this: depending on how they're investing that money, in times of strife, in times of financial turmoil, they may not actually have a true net asset value of $1. And there's the risk that it does something called break the buck. If you go back to 2008, there was a money market fund called the Prime Reserve Fund that invested in asset-backed securities, and they broke the buck. Things got so bad, people were pulling their money out of the fund, and there was a lot of turmoil, as you recall, I'm sure, in 2008. And as people started to pull money out of that fund, they had to start to sell assets. So now you've got to start to realize those losses, and they go, hey guys, guess what? Not really worth the dollar that we were saying it was per share. Sorry about your luck. And a lot of people went, wait a second, I lost money in my money market. How do you lose money in a money market? Because it was a money market fund, not a money market bank account. Big difference there. So as far as what's out there in the market right now and how it works, there are generally three flavors or varieties of these things. And so there are government funds, there are treasury funds, and there are prime funds. A government fund, exactly what it sounds like. They have to invest in short-term securities that are backed by the government. It might be treasuries, it could be other repurchase agreements or things like that. Short-term, but ultimately government-backed. And so there's not a whole lot of default risk there. We've got the debt ceiling stuff going on. We'll see how that plays out. But there's not a whole lot of risk. To this point, the U.S. federal government has not defaulted on anything. And so if you're investing in those securities by buying into that money market fund, you say, okay, I'm comfortable with that level of risk. The second route is treasuries. They can specifically only invest in treasuries, which are a type of government debt, a very specific type of federal government debt, and they're only allowed to play in that sandbox. If you cross over into a prime fund, and here's the thing about prime funds, they don't have to tell you, oh, we're a prime fund, by the way, and so we're going to be maybe a little bit more risky or have a little more risk to us than those other guys. They don't have to announce that. You have to go looking for what the fund holds. If you're in a prime fund, they have the ability to kind of go anywhere, and in times of turmoil, that could mean that their asset values drop, and if their asset values drop enough, that's where you get into a prime reserve fund break the buck sort of situation and have a potential loss on money that you in your mind viewed as cash. And so you need to figure out what it is that you're looking at. You can do that by searching out the fund, enter the ticker symbol, and then start to get into the holdings to see what's actually down there. And you don't have to get into the individual line item holdings. Normally there's sort of a summary that'll say by asset class what they have. And if they own things like asset-backed securities or commercial paper, those are two things that prime funds would hold. Those are inherently more risky. Now that doesn't mean that they are purely a risky asset, but they're more risky than what you would get from a US Treasury. And so that's what you have to compare and contrast. If it's cash and you're gonna put it in something that has the potential to lose money, that's okay, as long as that's all right with you, but be aware that that's a possibility. Don't just blindly go throwing cash into something and assuming because they market it to look like a bank account that it's actually in fact a bank account, because in this case it is not, and there's historic precedent of folks investing in something like that and then losing money. So that's where I'll leave you today. It's really nice that interest rates are higher if you are an investor without debt and with cash, because now you can actually make something from the portion of your portfolio that's in cash. Just be aware of where you're putting that cash, because all cash is not created equally. And we learned that today. I appreciate you being here. I hope you learned something. If you enjoy things, subscribe to the channel. Go ahead and click the button. Come back. We got lots of topics like this, and I'll see you another time. Thanks a lot.